I would want to briefly introduce the authors of the paper. So we have the presenter, who is our very own Professor Victor Murinde. Professor Murinde holds the AXA chair in global finance and is the founder and the director of the Research Center for Global Finance at the School of Finance and Management in SOAS here at University of London. He is a fellow of the Econometric Society. He is also a fellow of the Royal Society of Arts and a fellow of the Academy of Social Sciences. He has contributed to so many papers. In fact, in his profile, it says over 100 research papers. However, mainly in the area of banking and finance. And he's the SRIA lead on the FCDO funded project on research and innovation strengthening, in Africa. This project will last for 5 years, 2021 to 2024. He's a co-invigilator on an ESROSC funded research project on UK/Indian bilateral trade in fintech and fintech-enabled services. He has, he's also a principal investigator on another research grant, which is the FCDO ESRC research grant on inclusive finance, which ended in 2021, leading a consortium of SOAS University of London, University of Birmingham, Columbia University, University of Sussex, University of Nottingham. In fact, I would say I always see him as a grandfather of grants because he has been the principal investigator on so many grants, as well as co-investigator on so many projects. He's a renowned professor in SOAS University of London, and he's also visiting professor in so many other universities, like I think University of Ghana, Lava University, Legion, and the African Economic Research Consortium. His other roles include chair of the Group C Finance for the AERC, is council member of British Institute of Eastern Africa and visiting professor of financial economics at the School of Economics, University of Nairobi. He was chair Econometric Society African Region Standing Committee. That's between 2014 and 2018. Also, he was the founding director of the African Development Institute at the African Development Bank between 2011 and 2014. If I continue to read his profile, I'm sure it will take almost half of the day. And so I will just want to stop here while I talk briefly on the paper that he's about to present. The paper is titled, Did Post-Crisis Government Bailouts Reduce Tail Systemic Risk in European Bank? Did post-crisis government bailouts reduce tail systemic risk in European banks? And this paper is co-authored by Dr. Sajid Chaudhry of Aston University, Dr. Samuel Fosu of the University of Sussex, Dr. Wasim Ahmed of Cranfield University. In the paper, he will tell us more about what they did in the paper. But in brief, I think what they did is they investigated whether government bailouts post the global financial crisis were helpful in reducing systemic risk in European banks. And their findings are very, very interesting. And I will leave Victor to tell us more about that while I invite him to take over the stage. You are welcome, Victor.
Thank you very much, Kemi, for this generous introduction. I enjoy the introduction when I have grandfather status. So you put it. So that's absolutely fine with me. Now, let me now go ahead and share the presentation first in presentation mode. Well, it's a pleasure because every week I'm chairing the papers presented by other colleagues from around the world. And today it's a great pleasure to share with you some of the ongoing work and the Research Center for Global Finance. This time with the colleagues who I want to acknowledge their presence in the audience. Dr. Sajid Chadri from Aston, Dr. Samuel Fosu from Sussex, Dr. C. Mohammed from Cranfield. And we go a long way with Sajid, Samuel, and Wasim. In fact, at one point, I think we used to be the University of Birmingham group, all the four of us. And we have since then left into various dimensions. But back to this paper, this project started way back after the experiences of bank bailouts. And in a way, the global financial crisis broke out in 2007 and 8, and then followed by bailouts experiences in different countries, leading especially in the US and also in Europe, including the UK. But the debates were similar. And a key debate was, why should you use taxpayers' money to bail out these banks? These big banks were making huge, phenomenal profits, and yet also paying a great perquisites to the CEOs. And when the global financial crisis breaks out, then what happened is that the government is running with taxpayers' money to redeem these banks. So this is the important question we're going to look at in this paper. And my presentation will follow the traditional route of an introduction, the motivation, literature, and contributions. And then I will mention a little bit about the conceptualization and measurement of bank systemic risk that we follow in this paper, and the innovations in terms of the conceptualization of the theory, the data we have, and then also innovations in econometric methodology. I share with you an insight into the results. I also mentioned a little bit about the fact that we took great care to do robustness testing, and then I will offer some conclusions. And as I have all my other co-authors in the group, they may come in or now, or maybe at the end of the presentation during the Q&A. Okay, the issues. It is important to note that the bailout of banks by governments globally is a controversial issue. And this is not only unique to European banks, it is also important in other countries, including the US, and has fundamental implications, especially for governments and banks in developing countries where the resources have so many competing needs. And we bear in mind that in the global financial crisis of 2007 and 8, there were very intense bank bailout programs. Governments did spend a huge amount of taxpayers' money to bail out the banks that were highly vulnerable And their main objective was that this would possibly reduce systemic risk in the banking system. We say the money, the amounts were phenomenal in terms of the expenditures. And just to give an insight that the bailout costs, for example, for Ireland were 35% of the country's GDP in 2014. For Greece, it was 38%. And that's phenomenal, almost taking up almost half of the GDP for the year. The Netherlands, 17%, and UK, 11% of the country GDP. And these are phenomenal values, which cannot simply be ignored away. And however, it is important to note, as has been highlighted by some papers, especially Yoshi and Kashyap and 2010, and by Zotova and Shidasan in 2012, that this money was not spent on the same things across these countries. The money was spent partly in nationalizing some of the banks, in some countries where some banks were nationalized as a process. In some other say was the money was also used for injecting liquidity and capital into the banks. And some countries, the money was used for providing blanket guarantees to the financial institutions for them to be able to basically to restore confidence in the banking system. But the whole question is, in view of the overall objective of this bailout, which was to reduce systemic risk, did these post-crisis government bailouts actually reduce the systemic risk in European banks? What is the evidence? And this is what this paper is trying to address. It is useful to take a step backwards and to look at the related literature. What do we know? What is the current state of knowledge? We know that in the current literature, the existing knowledge, the argument of too big to fail, okay, systemically important banks, others call it SIBs, that the bank is too big to simply fail, it will shatter the economy. So this is one of the arguments supporting the role of bailouts. But there is another argument that if governments don't intervene, the cost to the taxpayers will even be higher if the financial system completely collapses. And then the government has to fix it again. So it's cost effective to bail out rather than to let it fail and then reconstruct. But what do the studies show? What evidence do we have to hand? In fact, there are two classes of evidence or strands of evidence. And on the positive side, on the affirmative side, that bailouts can help, some scholars have found that bailouts prevent bank runs and promote financial stability, including in actually the theory of Diamond and Dybvig, for which Diamond received the Nobel Prize for economics. This fundamental paper of 1983, which everybody reads as an undergraduate in banking, simply analyze this fact that actually saving banks prevent bank runs is important and promote financial stability. But there's also the papers of Damguchkant and the Triagish at the World Bank in 2002, which also makes the same observations and strongly in favor of bailouts to prevent bank runs and promote financial stability. Also, in the same strand of literature, there is the argument that banks will actually reduce systemic risk, across the banking system. And actually, the work of Allen at Imperial and others, Diamond Rajan 2005, Derishian, Ratunovisk, and the important recent paper by Calabrese are all corroborating the same evidence that bailouts play an important role in promoting financial stability and reducing systemic risk. But we also need to bear in mind that there is also evidence that points to the other direction. Okay? Because some studies show that bailouts can actually exacerbate moral hazard problems. And moral hazard problems, which are very much, because of asymmetric information, have morals hazard, you have signal extraction problems, and banks take comfort, right? Banks take comfort in the knowledge that they know they will be bailed out. And because they know that they will be bailed out, then they are prone to taking excessive risk. So this moral hazard of knowing, banks knowing what regulators know, we know they know that if we fail, we'll be bailed out. So we can push the risk element because, in the risk return plane, the more risk you take, the more expected return. So we push a little bit. The CEOs will be prompted to push a little bit and take excessive risk because they know they will be bailed out. And the work by Korean Yet gives evidence on this, especially in the US, Gotan and Huang, Virol Acharya and Humans 2007, Diamond Quota 2012. This is, controversial evidence there. Okay, what do we know? What do we now? Because we have strong evidence supporting a bailout. We have so strong evidence showing the dangers of a bailout. So we can observe in view of this, just we take a snapshot because there are many studies here which we will review were substantial, and the paper does that quite well in appraising all the works, including recent works. But the observation we want to take here is that there is lack of consensus. So a natural question arises from this a kind of a lack of consensus or conflicting evidence, this dichotomous view. And the question which arises is whether the financial system has become safe and more stable after the intervention that was experienced in Europe with bailout programs, or whether actually these bailout programs in Europe did increase moral hazard problems, thereby making financial institutions riskier. This is the basis of the question investigated in this paper. Let's also, if we look more at the literature, is that this evidence we have just cited, just went through, is actually one-sided. And it is rather surprising that it is limited and one-sided, focusing exclusively on the US. All those papers we cited. The only exception is the paper by Calabrese and others in 2017. These provide evidence of high systemic risk during the European sovereign debt crisis, and not the 2007-2008 global financial crisis. So one could argue that with respect to the global financial crisis 2007 and 8, the jury is still out there. We do not have so far, until this particular paper, we didn't have a paper that generated evidence to see how it happened. Rather, the many papers cited were mainly focusing on the US. But it is important to take into consideration that banks in the US, or the bank system in the US, differs substantially different from the banking system in Europe. That's number one. But also, the procedure for bank bailouts that was used in Europe is dramatically different from the procedures used that was used in the US. We know banks in Europe are much more concentrated compared to banks in the US. And the paper by De Jong and other 2017 actually makes that absolutely clear. In terms of the methods of intervention, Because European banking markets are concentrated, the governments in Europe usually had one-to-one talks with the CEOs of troubled banks to be able to confirm, ascertain completely that the provision of bailout programs to any particular bank is carried out exactly to strengthen it. This is a different approach from the one that was used in the US. The US approach involved congressional authorization to reach a bailout decision. And the paper by Berger and Roman in 2015 clearly brought out that particular element of the US bailout program. And therefore, because the method of bailout was different in the US and the UK and Europe, and because the banking system is different, we cannot rely on the results we have on the US banking system. We need to look at the results we can generate on Europe, and hence much more entrenching the motivation of this paper. But let me just let's highlight a little bit about what we mean to say that the structures of the banking market in the US is different from Europe, is different from in the UK. So we shall take some key indicators of the banking system. Some studies, some researchers and some practitioners have tried to put them as a camel. A camel. The camel is not the animal, the camel. That is about, capital adequacy, liquidity, and capital. So capital, liquidity, and other indicators. So we take an insight into some of the cases. If we take, for example, the total banking assets, okay, what we see in this appendix figure 1 in the paper, we show here the share of 3 largest commercial banks as a share of total commercial banking assets in the UK, and that's the blue line, the middle, in the euro area, and that's the greenish line on top, so it's higher, and that it is actually lower in the US. The data was taken from FRED, the Federal Reserve Economic Data. And you see here that basically these structure, UK, Europe, and US have different configuration in terms of total banking assets. What about in terms of liquidity? And here we take the liquidity assets total deposits and short-term funding ratio for the 3 samples. And you find again in the US, much lower. The euro is the middle line, and again, the different configurations are in the UK. And therefore, indicating the differences in the structure in terms of liquidity. But the same differences can be observed if we look at bank capital. And here we're taking the bank capital total assets ratio for these 3 samples. And to note here that basically the US stands out in terms of bank capital, but higher, UK lower, and somehow sometimes coinciding in something with Europe in some cases. But you see that totally across from the period 1997, encompassing the crisis period, the global financial crisis period, and on 2014, there are different structures, and hence just kind of motivating the fact that it was necessary to undertake specific paper, specifically empirical investigation in the case of European banks, notwithstanding the fact that some US banks have been studied in this particular context. So in this, against this background, our paper therefore investigates whether government bailouts post the global financial crisis, whether these bailouts were helpful in reducing systemic risk in European banks. And just as demonstrated just now, we exploit the distinguishing features of European banks that is compared to their US counterparts. So in terms of concentration, in terms of liquidity, and in terms of capital ratios. Thirdly, we make important a theoretical and methodological innovation. We apply the multivariate extreme value theory, EVT, to measure systemic risk. And this measure has not been used in this strand of literature with respect to banks. We also invoke a quasi-experimental approach. Experimentation is the way of going about issues, one of the breakthroughs in methodologies. And so we invoke a quasi-experimental approach by taking difference in difference methodology to examine the impact of the bailout programs on systemic risk in bailout banks versus non-bailout banks. We uncover quite a host of new findings, and I will be highlighting these new findings as we go. But altogether, these findings have profound implications for bank regulators in a way in how they should look at bailouts, and also implications for bank managers, the way they should behave should the catastrophe happen. And in one of my area papers, I show that the global financial crisis have been hitting the global financial system almost every 10 years. The cycle goes around, and in some cases, 80 years. So one can rely on some of these new findings to get an insight. What should we do? What should regulators do? And what should practitioners do? Okay, so here I will just briefly highlight a conceptualization. We basically look into the theoretical underpinning of what we are trying to do. We innovate by conceptualizing differently the bank systemic risk indicator. I'm saying this because the literature has had a number of studies in terms of how bank systemic risks are studied. And we want to go a little bit further and I'll explain why you do this. So we have a different conceptualization. And this conceptualization, we consider a banking system with n banks. N is a large number. It could be in the same country, but in this particular case, it is in the same continent. We choose the crisis levels. Here we capture, here where I'm showing the indicator. We choose the crisis levels or extreme quantiles. This is your QI. We screen the extreme crisis levels and extreme quantiles to have equal tail probabilities across banks. Okay. And so we take also this P is the marginal distribution functions of trying to show here in these marginal distribution functions that these are bank specific. Okay, so the general form we can use in equation 2, the general form of the joint crash of a large number of banks, the fact that many banks can crash, can fail, is conditional upon the crash of a subset of banks. So L is the large number, N is the large number of banks, L is a subset of banks. And we are showing that actually this subset of banks may unleash contagion. There is a high probability. This way, probability configuration here, probabilities unleash contagion that can be lead to the failing of other banks. And so in 2 here, the right-hand side of the equation 2 is just follows the definition of conditional probabilities. So the additional probabilities, where the probability is actually ranging, from 0 to 1, 0, impossible, and 1 certainty. And that's the range of the conditional probability that we are looking at. But we are actually interested in the bivariate systemic risk measure. That is the probability of a crash of a bank, say where n is equal to 1, is conditional upon an indicator of aggregate risk L equal to 1. That's why we're comparing error and risk, And the way we consider this is comparable to what is used in the finance literature. In the finance literature, we know when we are trying to measure systemic risk, we use a simple capital asset pricing model. And a simple capital asset pricing model, we are trying to see, say, the return on a share or the company subject to the entire listing of the market. We are looking at the London Stock Exchange, the Fosu 100 versus, say, a Barclays Bank. Okay, we are trying to say basically it is to be, now we use the beta, the sensitivity. In this configuration conceptualization, we are trying to say, actually, if you look at the spreads of the market risk, okay, it's not the beta per se. We know the distribution of the returns is bunched, okay? It has a bunching effect. That's why estimation using arch becomes important. But what matters is the tail distribution within that beta. And it's that tail distribution we are going into, okay? So the problem we're trying to recover is in the tail, okay? It's not the beta per se, but the tail of the beta. And that is why we invoke that term of tail beta, okay? So the term tail beta is a measure of extreme, right? What extreme here is used informally, is a measure of extreme systemic risk, okay? And is therefore equivalent to the classic CAPE model, but emphasizing the tail distribution, okay? Okay. And if we do not access returns on the market portfolio, if we invoke the excess return on the market portfolio by XM, this is the market, XM, okay, then equation 1 can be reconfigured in terms of equation 3, okay. And that's basically we are trying to reconfigure how the tail beta, the beta distribution, or within from N banks and error banks, how they rate. And the probability is that when one bank fails, the others may also fail. And that's basically the risk of the event. Now, the paper has an explanation, a conception of this theory, as also an appendix on the theory. But what I want to highlight here is that once we get this conceptualization right, the challenge is, can we actually measure it? Okay, in theory, it seems very attractive. Okay, can we measure it? Okay, and then we look to the estimation, how we can now estimate it. Okay, we argue here that we are not only conceptualizing it, but we can actually estimate it or measure it. So we estimate and take our measures with the same parametric estimation procedures for systemic risk. So taking the probability measures in equation 1 and 2, which we have seen, we need to estimate the multivariate probabilities, the probabilities of different variables, okay, which are defined on the intersection of sets between N and L. And therefore, we actually are kind of converting the bank stock returns to unit Pareto values and this, and then undertaking the estimation for entire beta of each bank, okay, in the observations sample, okay. So, and this measure that basically makes this work different from the existing papers. This simple definition of the tail beta distribution to measure the exposure of risk to the banks during the global financial crisis. And at the best, if we use this extended measure, we can plot the estimators as a function of a threshold. So we have a threshold. Everything here is done within a threshold because any risk and return has to be compared against the threshold. And with this threshold, we have got the mean and the standard deviation. So we select the M in the region over which the estimators have to be constant, and we can choose M to be about a 200 maybe Hill plots to find a way of working with this huge amount of data. Okay, and this again that we can extend these measures even when we can also experiment with the distribution of the banks within the country. For example, we could look where Q is large and P small. We can see how the variations can occur. We can also look at the multivariates, trying to look as, for example, in 7, the core crash probabilities, the probabilities that crash in one bank is going to lead to crash in another bank. And then we're able now to estimate the probabilities for any banks in equation 9. And look for the thresholds that are used, for example, by the adjustments in the alphas. Okay, so if we have a good theory, sometimes you said you have a beautiful theory, but this beautiful theory could be assassinated by ugly facts. That is to say that the theory may appear very beautiful, may elegant, but when you look at the data to estimate the theory, test the theory, the result may be as not beautiful, may not be as beautiful as you think. But what about in this particular case? So let's look at the data. Okay. We take data, we first of all take the universe of all the banks in all the European countries. We find, however, some limitations in the bank availability, in data availability. We also find that we can only work with the 66 banks, proceeding scientifically. We can work with only 66 banks from 10 European countries. Okay. Banks in only 12 European countries received support in terms of the bailouts from the governments or the central bank. Okay, in only 12 European countries. And these European countries are listed here from Austria, Belgium, France, Germany, Greece, Ireland, Luxembourg, Netherlands, Portugal, Spain, Sweden, and of course, the UK. Now, observers may say, oh, when is Spain? We exclude Spain and initially Luxembourg in this, this is what 12 minus 2, that's the 10 European countries. So the excluded ones were Spain and Luxembourg from a sample, because Spain only provided state guarantees to the bank, Caja Castilla-La Mancha, and Luxembourg provided capital injections into Fortis Bank, Luxembourg only. And Philip Molyneux Bango, in his paper 2014, made that observation: who participated in the bailout and who did it and why. Okay. So our data period is from the 2nd of January 1990 to December 2014. And basically, this means we are able now to cover the period before the global financial crisis and well after the global financial crisis. That's how how large the data is. It is usually reassuring to try to see an insight into when we take all this data that we have, plenty of spreadsheets covering all this data, bank by bank, country by country. But how does the data look like in terms of discrete statistics? Do we have any worries? And so we look at the means, the standard deviations of the variables of interest, and also we look at the percentile, 25th percentile, the median, and then 75th percentile, and then the number of banks. And the variables we're interested in, which are coming from the conceptualization or the theory, which we are going to take forward into the empirical version of this work, include the key variable, like the tail beta, okay, new measure. We are not using betas per se, but use the tail beta. Okay. Then measuring the bailout bank, using a dummy, okay. And then interaction terms of, say, for example, post bailout and then bailout bank to see how the behavior of the interaction in this specification. We also look at capital adequacy, an element of CAMOS, asset quality, an element of CAMOS. You see the CAMOS in these three: capital adequacy, asset quality, management, earnings, and liquidity. So that's the camel, not the animal, but the bank camel that has the capital adequacy, asset liquidity. And we look at, we provide data here. And as you can see, we don't have any outliers to make us worried. We also look at the variables of interest, like bank size, asset growth, loan growth, long-term to total funding, a non-interest expense ratio. Then the tail quintile, and then expected a shortfall, because expected shortfall could be another measure of tying in risk. And then the 25% of the cutoff of the expected shortfall. So what we find reassuring in looking at the descriptive statistics, we look at, say, these moments that there are no outliers to make us very wary on whether that there might be problems of getting any signals into results because of outliers. Okay. So given the conceptual methodology or conceptual framework, given the measurement of the tail beta, given the data we have, we are in position now to undertake an empirical specification. And we take a quasi-experimental approach where we know we have a treatment group that received a bailout package. We also have a control group that did not receive a bailout package. And therefore, difference in difference is the appropriate methodology. Now, I know that there might be a criticism to say that really the very fundamental element of the quasi-experimental way of doing this is randomness. And the governments and central banks do not choose the banks randomly. So neither, but we do later on control for this using other econometric techniques of trying to look into the samples and try to see whether they exhibit some elements that is akin or similar like randomness. We take, first of all, we specify a basic econometric model in which we have y as the dependent variable. This y represents the probability that a bank will crash, conditional upon an aggregate shock to measure systemic risk or tail risk. This is consistent with the theoretical conceptualization that we show that basically by looking at C, is the risk targeting Barclays going to be completely dismantle the entire UK banking system? Okay. And so that the dependent, we also have the bailout bank, that's, beta 1 for the bailout bank. This here we use the dummy for whether a bank received any kind of bailout, that is 1, and 0 if it did not receive any support. We then have beta 2 on post bailout bank, and here post bailout bank is a 1 for the time element of 2011-2041. That is after the global financial crisis, after the bailout. Okay, so this is the kind of timing, the period after EU, after European Union bailout program. Okay, so this beta 2, okay, which is post bailout times bailout bank, that is the interaction term, is the difference in difference term, capturing the effect of bailout after implementation. That we focus on that so much because that's the signal we want to see what is happening to that coefficient. to show us whether, bailout works, okay? And then we have, other variables here where we have the XIT, and then, of course, we are also adding the XI are the controls, yes. The usual suspects in the policeman rounding up the usual suspects in terms of a crime. So we include it in this modeling approach. And then we have time, annual time fixed effects, and we also have a country fixed effects, and then another term. But we then modify our econometric model to be able actually to bring in to capture the main elements of how this could be configured, how we can configure and bring in the big experience. And here we are basically looking at how we can combine and then have a different configuration of capturing the tail beta in all these aspects. Okay, what do we find? Here, share with you the results, and maybe it's helpful to proceed systematically in terms of what we covered. This is the first round of results, which basically is trying to capture the effect of bailout on a systemic risk. And in this table, we are showing the results of difference in difference regression estimates to analyzing the impact of bailout for 66 banks from 10 European countries. And the measure of systemic risk as conceptualized is tail beta, using here data from 1996 to 2014. And, bailout, as explained, is that MA equal to 1 if the bank received any intervention from government or the central bank. Post-bailout is covering the period 2011-2014. And therefore, we are now looking at the coefficients of the, and of course, the t-values and the coefficients, and also the significance, but also categorizing the results into 4 sections. In the first regressions, all of them are tail beta, but the first regression, we have the results for excluding controls other than CAMO. In the second result, excluding proxies for CAMO. In the third regression, a full specification with high risk but 2 correlated controls. And then also in 4, another extension, but also allowing some variables to actually drop out in a general specific way. Now, the variable of interest here is the one I'm moving my cursor to. Post-bailout, okay. Post-bailout interacted with bailout banks, okay. And so that is the DID term. In terms of statistical significance, yes, this is significant in all the 4 equations, okay? So showing really, okay, the results indicating that the systemic risk of bailout banks was reduced after the post-bailout, after the bailout. So in other words, showing bailout worked. And that's a statistical result showing a negative value significant. But there is also an economic interpretation to this result. And the economic significance or interpretation is that, for example, here in the first regression, the coefficient on the difference term is negative and is negative 0.04. Okay, significant at 1%. which translates into a substantial reduction of 4% in the systemic risk following a change in bailout from 0 to 1. So that the 4% gain in systemic risk is very important. That's the kind of stabilization. In the second regulation, it's 3%. The third regulation, 3%. The fourth regulation, 3%. So you can say overall that it hovers between 3 and 4%. And that's a big a reduction in systemic risk following the bailout. Okay. And we find that is significant for again other covariates, say in management. We find that bank size is very important, and we shall go back to this in a moment. Asset growth is important. Non-interest expense ratio is very important, and so those results in table 1 are reassuring. But let us also extend this analysis into table 2. And we present here the results for table 2. And here we are trying to look at, we are present the results of difference in difference panel regression estimates. So undertake a huge comprehensive panel, okay, for analyzing the bailout of 66 banks from 10 European countries. And again, the measures are similar to the measures in table 1. But here we actually have a cohort of about 6 equations in general. In the first part, equations 1 and 2, we are looking at the baseline model with bank size interactions. Okay. In equations 3 and 4, we are looking at the baseline model with the liquidity ratio interactions. In 5 to 6, we are looking at baseline model with the capital ratio interactions. We are trying to show that some of the common elements can be taken into account directly in the regression. Why? Because we did show that European banks are different at the start of this seminar. We are trying to look into insight that actually European banks are different from the US counterparts in terms, according to the plots that I showed, in terms of liquidity ratios and the capital ratios and others. So this is factored into the analysis. Now let us watch our variable of interest, which is a post-bailout, bond bailout, this time with big banks. The coefficients 0.04, 0.03, series system effect that actually bailout reduces systemic risk, and the same magnitude hovering between 3 and 4%. Even for small banks, look at the results. For small banks, actually 4% is just standard. Okay. So what do we see here? We see that actually bank size does not matter. Size does not matter. The results work, that the bailout worked for European banks, whether you think in terms of the big banks or in terms of small banks, the results are the same, give you the same result. Suppose you are looking at the banks in terms of liquidity, classifying, differentiating between high liquid banks and low liquid banks. What do we get? High liquid banks interaction term 0.2, 0.2, 2% reduction in systemic risk. Low liquidity banks 5% and 4%. Okay, we are hovering the same. Suppose you also compare the banks in terms of capital size. High capital banks, you find a 6%, 5%. Okay, and low capital banks, we find about a 1% and about 1%. So again, some of the indicators that we have, like bank size and others, are still very important. And therefore, we are getting a conclusion from table 2 that actually the bailout did work in terms of reducing systemic risk. Okay, now we also use instrumental variable analysis. This is to address problems, potential problems over the endogeneity, and be able to create instruments that can subjugate against this. Okay, so again, we have our variable of interest, which is the interaction term, post-bailout and bailout banks, taking big banks, and again, also looking at stage one, of course, in the process, stage two that we are looking at here, stage two results, and stage two. The first is the baseline model with the tail quintile as a tail risk measure. And the second is expected shortfall as a tail risk measure, which is, again, one of the measures in vogue in the literature. And the results are the same, that basically consistent with the earlier finding that the bailout did reduce systemic risk in the banking systems. Again, whether you look at small banks or big banks, or whether you look at high liquidity or liquidity banks, or low liquidity banks, you still get the same result, consistent results, and more or less in similar magnitudes of the economic interpretation of the econometric results. Okay. And this is to show, of course, in the paper, you find all the scientific diagnostics, so statistical diagnostics, to which are reassuring that what we're estimating here is a plausible or consistent or done scientifically, and I will not go into this interpretation of the tests that we imply, but they are given in the paper in here. We also, to address one of the questions of reverse causality, also we undertake here the Heckman selection model. Okay, we are here trying to address the issue of sample selection bias, because the bailout recipients are not randomly assigned. Okay, the bailout governments in Europe didn't say, okay, we just take the banks at random. Well, I wish they had. Yeah, maybe it would happen, but they did just have a criteria for doing. So we can correct this to do the correction by running, by invoking the Heckman correction procedure. It's a two-stage selection procedure. Whereby, similar to the instrumental variables we've just done, we run a probability model to regress bailout dummy on the financial hub dummy and order the controls in the first stage. And when we finish the first stage, we then estimate the inverse means ratio. Okay, this is our self-selection parameter for the first stage. And then we go to the second stage. We include the inverse means ratio as an independent variable in the second stage, and the dependent variable is our measure of systemic risk. And the results is what we present here in table 4. As you can see, the inverse means ratio here. And of course, let's now focus on the picture that we are interested in. This is the gold dust. This is the gold dust we are seeking. Is this a variable big cost bailout for big banks? 0.3% of econometric meaning. This is 3% in stage 2. That's consistent with the results. For small banks, 4%, 5%. That is consistent with the results. Look at it also in high liquidity. 2%. In low liquidity, 5%, 4%. These results that control use a Heckman selection procedure give us consistent results with our initial findings of saying that bailout did work and did reduce systemic risk in European banks. And in terms of interpretation, something in the region of 3 to 4%. Okay. And then these are some of the results. Okay, so I don't know how long I've been running, Kemi, but I feel I could run on forever. But let me perhaps say the conclusion.
I think you've been on for about an hour.
Okay.
Almost an hour, yeah.
Yeah, okay. Yeah, I think the best formula I like for presenting a paper is to present until you are stopped. Okay, then stop me. But here it was okay. So basically, to sum up here, we are investigating in this paper whether the bank bailouts have actually helped reduce the systemic risk of European banks following the global financial crisis of 2007. With respect to European banks, this issue has not been studied earlier, to the best of our knowledge. Okay. We also innovate, and for the first time, we use the multivariate extreme value theory, which we conceptualize, show how it can be estimated, and then test it. Okay. And we test it to calculate not the conventional beta that has been used in finance for a long time, not the tail beta as a measure of systemic risk. As I say, okay, this thing is always in the tail, literal translation, basically. The thing is in the tail. So the distribution of the beta helps us to say this is where the problem is. So tail beta is a measure of systemic risk, where tail beta is actually the probability. What does it mean? The probability of a drop in the bank's equity value if there is a negative systemic shock as embedded in the global financial crisis. We uncover new results. We find, for example, that bailout packages reduce the systemic risk transmission to European banks. Even when we control for idiosyncratic risk of banks measured via Taylor quantiles, or we use extreme expected shortfall measures, conventional measures, these results persist, saying the same truth. Okay. We do not say we torture the data to confess, not the data have already confessed that this is academic findings. What is interesting in these findings is that actually in bailouts don't always aim at bailing out the large banks that are too large to fail, or the systemically important banks. That actually there is no difference in the bailout in this reduction in symptoms for large and small banks. That has important implications for regulators, and for the next time we'll do it when crisis, because there is a temptation, an argument in the literature: save the big banks, the small ones will also survive. No, the same risk for large and small banks. Also, when you look at it in terms of liquidity, yes, high liquid and low banks need to save. Maybe this has important implication, of course, for COVID-19 implications of past performance. Okay. However, we find something important about capital. Maybe something that resonates very well with Basel III. That only safe and healthy banks, the high capital, are more able to reduce systemic risk going above 3% to 4% and 5%. We are not trying to sanctify our results, but our results are really robust. They are robust, strong to endogeneity and self-selection bias. And this paper, therefore, offers policy implications of bank regulators I've mentioned in how bank regulators as central banks should behave, and also governments in support of bailing out the banks and finding way of dealing with the moral hazard, and bank executives to the bank CEOs to be able to take on board some of these packages and convert them into a success. And that's the paper, basically. Thank you very much.
I think we should give Victor a clap. Well done for that presentation. What was I doing? I was trying to give you a clap, but I was busy raising up my hand.
Okay.
Yeah, thank you so much for the presentation, and well done to the authors of this paper, because I can see that a lot was done in that paper. I expect that, no doubt, there should be some very good comments which I would welcome from the audience. I think, let me see if there's anything in the chat. I think I could see something. Oh, there's a question in in the chat box already from Refilwe Maleka.
Yes,
I don't know. Yeah.
Yeah, I can see. Referee is a good participant in the CGF series, and always full of brilliant ideas. She does raise an important question. What are my thoughts on the opinions of the crypto advocates who argue that no amount of digital change will sufficiently manage the systemic risk within the banking system? That further bank runs can be expected, who are adamant that crypto is a solution to this, and governments who want to maintain this. Do you believe that this question? Well, first of all, I'll first deal with that.
Okay.
The bank risk, okay, is an integral component of the way banks behave. Risk is an integral component of finance. In fact, if you remove risk in finance, then you have no returns. And that's the basis of a simple capital asset pricing model, okay? It says that entrepreneurs, investors, bank managers go to address, but they try to mitigate the risk. When a systemic risk comes, that is blanket risk at the global financial crisis, hits everybody. It doesn't choose, okay? That's systemic risk, okay? It can come, and it has been happening in one of my previous papers I show, it has been happening every 8 to 10 years. So crypto can have their theory, okay? But let me say crypto will also have its own individual risk. And the risk that a crypto has is predicted in a theory called the S-curve theory. The S-curve theory says when there's a new innovation, it works beautifully, it transforms everything, and it goes on until the time when it starts actually getting diffused, that the risk picks up. So I can say, risk is part of finance, and crypto will have its risk. The S-curve theory can allow you on where crypto is going. Any innovation in finance is likely to go this way. The second question was, do you believe that the recent quest to make executives pay back the remuneration after the most recent banking crisis will make a significant contribution to managing banks? I think it will address moral hazard. Rafiri, I'm with you there. I think it will reduce moral hazard. Thank you very much.
Thank you very much for dealing with those questions. I think I saw a hand raised up by Suliat. Okay.
I think
Suliat, are you
Professor Srait Tumine?
Do you still want to ask your question, or are you withdrawing your hand? The hand was raised up earlier, but I cannot see the hand anymore.
Okay. Professor Srait Tumine is
okay. I think there is one by Professor Hongbo.
Yes, Hong. Good to see you.
Please, sorry, I should. Thank you very much, Victor, for your presentation. Sorry, can you hear me? I have some problems.
Very well.
Okay,
very well. Yeah.
So I have a question actually regarding your econometrics, so DID, and in your model, I didn't see the post-dummy. So how did you define the post? You have the treatment group versus non-treatment group. You should have a post-dummy. So how did you define this post-dummy? You said you are checking the impact after the financial crisis. But I was wondering, maybe banks have received government bailout at different point in time. So I didn't see anything in terms of this variable. Can you maybe explain a little bit, or your co-authors, where are they?
I think Samuel is raising his hand.
Yeah, that's my question.
Maybe Samuel wants to come in. Yeah.
For the
we did that deliberately because we subsumed that into the time fixed effects. So you will see that we control for time fixed effects. So if you put them in, you will have perfect collinearity. And that's why so definitely the software will drop some of these time fixed effects haphazardly. So to control for that, we have to tell the software what to drop. So we drop those dummies to avoid this problem of collinearity. So they are subsumed into the time fixed effects.
Yeah, but Samuel, how did you define it? Did you define post is 1 for the years after 2007?
Yeah, so
altogether?
So we have the post, we have very obviously the period of interest. So if you have taken the period after 2007 as a post, then of course, if you have time damage as well, what we are saying is that you will have perfect collinearity. So we will have to drop off, and it's a standard treatment in DID framework of late in recent econometric advances. And you will realize that it won't make any difference. The worst you will get is that if you include them, the software will itself drop some of these dummies in a way that you might not want. So to control.
I understand. Sorry, Samuel, I understand what you are saying. And for the second part of my question, I was asking, what if a bank had received the bailout at a different point in time than another bank?
I think I understand.
So what about a dynamic post?
Yeah, I think I really understand where you are driving to now, because we have used staggered DID framework. And this staggered DID framework, recent econometric advances have shown that the different treatment periods we have in the data can in itself pose a problem. And these papers didn't start coming out until after, the last year or so. So it's something we are aware that we may have to incorporate so that we can have things like new recommendations by Callaway and Santana, and then also by a few other research. I think my colleague Wasim will have a lot of ideas about this as well. And basically, yes, we have different treatment periods. So some of these perhaps will have been received the help or bailout in different timing periods. We will have to look at how the different sample sizes within each of these groups impact on our average causal effect. And I think a good methodology is provided by, if I can, Andrew Bacon, Goodman. And I think it's something that we can look into to see how the weights differ in terms of the different cohorts, if that addresses your concern, Professor Bo.
Yeah, I think I can see something, but you may get a comment from a referee or something like that. Thank you.
Thank you. Thank you.
Thank you.
Thank you. Yeah. I don't know. Do you want to add to that, Victor?
No, at all.
Okay.
I just want to appreciate that those important observations by Hong are very, very, very useful. And yeah.
I think we have Professor Suliat is back. We lost her the other time, so she's back. Professor Suliat, do you want to ask your question?
Yeah, I want to do. Thank you so much, Kemi, for the opportunity and the presenters for the job well done. Maybe mine is, these are about a few things. One, I look at the study being for the post-financial crisis of 2007, 2008. We are now about 10 years and or plus from that period. How relevant do you think it could be now to the policymakers? Perhaps if you would also take it further to incorporate the post-COVID, because I understand there were bailouts, some banks, some companies, maybe it would be significant to perhaps policymakers. That aside, the issue of the difference, for example, you are doing, how I wish first you would also incorporate or bring in, before you go into the parentheses, the issue to do with the Turkey's post-hoc analysis, to look at the significance differences among the said banks, categorizing by assets into medium, small, and large. So that's the significance differences, preferably before the crisis and perhaps after the crisis. What was it before in terms of the sensitivity risk or the systematic risk, and what was it after the risk when the bailout were done to some banks and to the non-bank? Then how would it fare, or what would it be in terms of that? Maybe the third one is, for example, what lessons? I have seen your conclusion, but measure the policy implication on whether should we always bail out banks when such crises happen, or we should not. You talked about it, but it didn't shout out well. What is the strategic focus in the medium and in the long term? Should we always bail out banks, or there must be an intervention done by banks? Otherwise, if we start bailing out private banks, yet the returns are taken by the shareholders, look at the implication. You are using taxpayers' money to recommend the bailout the private company. What is the long-run implication to, for example, the treasury? Those are some of my few comments. Thank you.
Great. Thank you very much, Slide, and all their comments are absolutely helpful. On the first one, the time dimension of that, the global financial crisis is more than 10 years away. Still, that is very important. The fact that we needed to cover this dimension because so far, the specific banks of Europe compared to the rest of the world, there hasn't any rigorous econometric work to shed light on actually the role of bailout. So there was a lacuna, a gap that needed to be analyzed, and that's what we do. But we also know that the financial crises have been happening almost every 10 years. And this study, therefore, is to say, look, policymakers, practitioners, it's going to happen. If you look actually back, way back to, 1997, the Asian flu, starting with the collapse of currencies, and that was also due to banking. So in my previous paper, I show that almost 8-10 years banking crises occur, and we should be able to manage them, much better. In fact, the analysis we undertake here gives you a better cooling off period rather than kind of immediately. You couldn't have done this in 2010. Because the post-bailout crisis is actually 2011, 2014. That's how we measure the, post-bailout bank period. So I think the relevance of where we are is not a problem. It's whether what we get helps us to anticipate, what we do, how we can behave, and indeed, to relate this to your final part of the question, was should we bail out banks? The answer is yes. Okay, the answer is yes, because what you see is that it's instrumental to stabilizing the economy. The question, though, for the treasury, for central banks and also finance who use taxpayers' money is, okay, is this money recoverable? And yes, it is. Okay. It's a convenient banks, but contingent on the behavior of the CEOs. Okay. And whether this money is recoverable in the short run. Now, if you look at European banks, or say, if you focus on UK banks, UK is the largest international banking center in the world. Okay. For that means that the earnings are like exports, and have the highest earnings from banks as exports globally. Now, if the banks collapsed, that would be wiped out. The tax recovery, but that's beyond this paper, the tax recovery that you can get from the banks that will continue to function is much more higher than possibly the bailout. Okay, so I'm just taking an excursion onto this, but we wanted scientific proof. We wanted scientific proof, first of all, to say that yes, bailout worked, stabilizing the banking system. And after that, you can then feed that into the policymakers, make interpretation in terms of what you do. But we would say, on the basis of these results, it's assuring that bailout works. Now, you also mentioned about the way of reporting. I think I agree with you at that point that, for example, our appendix table 1, which gives out the discrete statistics and the moments, could be presented in such a way that we capture the bank size and others. However, in the regression, we do take into account the variations in bank size, the variations in liquidity, the variations in capital. So, but that table could be expanded to actually give kind of breakdown and see even the quantiles of the various measures we use. So, thank you very much for those 3 focus. I don't know whether any of my co-authors have something to add. I don't know whether Sajid managed to make it, but I can't see everybody on my screen. But
can I take you up a bit on that last question?
Yeah, sure.
Victor.
Yeah.
Although I'm not a bank or finance researcher, but I was just pondering over that question of whether to bail out banks or not. And what just came to my mind is what checks are being put in place to ensure that banks do not abuse being bailed out? Because if they know that whenever there is crisis, they are going to be bailed out, is there anything that the regulators have put in place to check against abuse? And another thing that one might want to consider quickly with that is, what effect would that then be on depositors? Would it have any effect on depositors? Any, just the thoughts that came to my mind. Okay, so.
Yeah. So I think that's a very useful question, Kemi, actually. What have regulators put in place? I think you are kind of articulating the moral hazard argument. When they know, we shall be rescued. We know they know we shall be rescued, and therefore they take risks. And I guess they are standard regulators, tools in taking, kind of deposit insurance or reserves. But as we know, when the crisis, especially the global financial crisis or even the Asian flu, the types of these crises are really systemic, that wipes out all that kind of thing, that runs respect the reserves or whatever insurance you have taken. I guess the most dramatic regulatory change after the global financial crisis was the introduction of the ticking of Basel. Basel rules are the metrics by which banks are regulated over the world. And actually, they started as being Basel or Basel I. Then banks failed, and then they produced Basel II. And then banks failed again, and then they introduced Basel III. Basel III is still invoke, and if anything happens, we possibly go to Basel IV. So yes, Basel III had some time. The template was very much changed to be able to accommodate some of these changes. Maybe we should actually in this paper mention a little bit about the implications for Basel. So that's the implications for Basel III. Because after all, the last line you saw where I was saying banks safe and healthy, capital becomes much more different. That has implications for Basel III. Yeah. Basel III, the current template of the bank. Yeah, thanks. Yeah.
Okay, thank you very much for elaborating on that. I think I can see someone's hand raised here. Let's see. That's JDeep.
Yeah, hi Kemi, thanks. Hi Victor, it was a really interesting presentation. Thanks for that. I have a very quick sort of, I mean, not that quick. I just want to sort of try and understand a little bit more in terms of the theory, that the connection between the intersection of the number of failures that you'd shown there, the probability of of a failure combined with the tail beta. So because I thought there should be a summation somewhere there, because you're looking at the intersection of sets and you're looking at the intersection over n different banks exceeding a particular sort of a threshold, and that's a probability. So presumably, if 2 banks exceed, or 3 banks exceed, or 4 banks exceed, there should be some kind of the probability of all of them exceeding is much lower than the probability of 2 exceeding or 3 exceeding that threshold. But I didn't see any kind of way of where it was summed up somehow, this probability. So I wasn't sure what the n really meant in your sort of analysis. So that's something I was hoping you could explain a little bit, just so that it makes sort of a bit more sense to me. So.
Yeah. Thanks, Jaideep, and for the comments, and for being able to come this paper. I think we would be interpreting this in terms of the joint probabilities, for a combination of different probabilities. And yes, we could summate probabilities I to n. I think we could express an aggregation. We look at it and find a way of expressing the aggregation of the different probabilities. Yeah, I don't know whether my co-authors have another insight into this. Yeah, but when you mentioned that, they say, okay, joint probabilities have to be expressed in such a way it's very clear, and especially when the difference between N and L is that you are looking at the one bank becoming problematic, and then what happened to the rest of the sample. And what happened in the sample is actually joint. So the joint probability could, again, be high or could be low. If it is high, then of course the failure can be classified as contagion, or if it is low, then possibly the risk has dissipated and has not affected the rest of the system. Yeah, we will look at that. Thanks very much.
Yeah, no, I understood that now. Thank you. So that when you explain it now, it becomes really clear to me. So that's perfect. So thanks for that.
Yeah.
So
Thanks. Yeah.
I have one more question, if it's okay for me to ask.
Yeah.
So one of the other things that I was thinking about was, because the sample is not huge, is it worth looking into certain other things that might be interesting? So, for example, presumably we're looking at the tail beta of the banks that were actually sort of bailed out, but a lot of the other banks were probably sort of simultaneously receiving support, not to the point of a bailout. But there are pre-bailout conditions in which support is provided, right? So, I mean, there's other ways in which banks are helped through short-term liquidity measures and all kinds of other things. And to what extent could that have anything to do with this measure that we're looking at, this impact that we're looking at? And secondly, is there any sort of time in which you could separate out multiple bailouts versus a single bailout? And did that have a differentiated effect? It would be kind of interesting to just look at, because you have the data, you've done the results already. So it might be just interesting to put an additional table there to sort of, or unless you've already seen that and you have a comment on it already.
Okay, those are also two brilliant comments. What support did the other banks receive? I think we should make it clear, because we are only here trying to capture the large government or central bank bailouts. We're also capturing the extent of the negotiations between the governments and the CEO of the commercial bank. But it may well be the case that banks also received some other support to sail through the system. It may or even complicate matters and say that those banks which we regard as control banks in the case they didn't get government bailouts may also have received some types of banks. We don't know, but we can check and document this because it helps clarify the argument. The second part, the way I'm not sure that I got this quite correct. When you say multiple bailouts rather than single bailouts, what do you mean here?
So I'm just curious as to whether, so for example, if there were like two banks failing at the same time and they both got a bailout, as opposed to one bank failing and it got a bailout, or whether the number of banks in prior to the bailout in distress has any relation to the results. It's not necessary that it's the case, but I'm just wondering. I'm not even sure if there were any incidents like that. But so, for example, in the US, it was clear that sometimes many banks needed to be bailed out, and sometimes only one bank was bailed out, and everything was sort of calmed down as a result. So, is there any kind of differentiation of that type in this data set? I'm not sure if that is.
Yeah. That's a very important question, I say, and especially it has to do with the timing of the bailouts. Since this crisis happened when I was alive and kicking and around and keen watching Northern Rock. The responses in the UK were almost instantaneous. So at any one time, I guess across the 10 European countries, the negotiations were taking place with the banks more or less at the same time. So the injection was not passing by. It was a injection across a number of banks in that short period. That's why we have this window of 2011, 2014, in which the bailout kind of occurs. So I would think the bailout was the injection in each bank was actually possibly done across a number of banks. Okay. And however, the point you have is at the start of the paper, I did mention that the bailouts was reconfigured or took form of happened in many forms. The bailout was not the same. There was one nationalizing the banks, turning a private bank into national. Okay, that's complete support and bailout support. Okay. Another one was injecting liquidity and capital. Okay, similar liquidity. Another one, provide guarantees. Okay, now, we do not show whether these various forms of intervention or the different types of bailouts produce different results. Okay, I think that's outside the scope of this paper, and we should acknowledge so. But yeah. We don't want to sanctify our results in that regard. Yeah.
Thank you so much.
Thank you very much for that question.
Let me ask to see one of my co-authors.
Okay, maybe they have a contribution.
If they have anything, observation or comments. I think we are all reading from the same hymn sheet, so this.
Yeah. I don't know if anyone has any further comments or observation or questions. Or perhaps the co-author might want to add one or two things to.
I would just say maybe that's a very good point raised there, and I think Victor has provided a very good response in my view to it. I think what we looked at was whether a bank received any kind of support. And I think going forward, perhaps we might be able to dig deeper into the specific kind of support if we the data will permit that, if there will be data available for that. But it's something we have to investigate. And I also liked your question, Kemi, on the whether what lessons we've learned from this bailout and whether that should be the norm, given that the banks can anticipate that and behave imprudently. I think Victor tried to answer this from regulatory perspective. And I think maybe looking at it in action too, if we look at the current recent occurrence with, say, SVB, the Silicon Valley Bank, how regulators move so quickly to liquidate this bank without taxpayers bearing any cost, you know, and also depositors losing a penny. I think lessons have been learned. So where they can move in quickly and have an efficient liquidation process, I think we've seen them taking that step. But there will be a case where perhaps it will be imprudent to allow a bank to fail or a couple of banks to fail. We've seen that with Lehman Brothers. With the benefit of hindsight, we know that maybe Lehman Brothers shouldn't have been allowed to fail, you know, and what was the criteria for saving the other banks? AIG receiving help, others receiving help, yet Lehman Brothers was too interconnected to be allowed to fail, and perhaps we did not take this into account. And I think the simple thing here, I think a rule that we can go back a few years or several years ago to the Beijing-Hut rule about yes, rescuing banks, but at a penal rate, you know, banks having to have a sort of a skin in the game, you know, and I think that's what SVB suffered now. And there will be times that when that will be imprudent, and I think there will be a different kind of approach to it. So this is a long-going debate, and what we try to do is to provide some scientific support evidence, what the data tells us. And I think perhaps we can dig deeper with the availability of data, but currently maybe these are some limitations we acknowledge, but maybe we can look into it, other facets of it further. Thank you.
I think you have done a brilliant work with this paper, and I must commend you, and I wish you all the best with the paper. Thanks to everyone that has attended as well and asked questions. I don't know if there is any further question. Otherwise, I don't know, Victor, do you have
Oh, I thank you, Chair, and I thank the seminar participants for Bulgarian. And if they would like a copy of the paper, we can send a copy of the current variants. It's work in progress, but we are happy to share it and get further comments before we subject it to another round. It's now on a second round of being reviewed, and we acknowledge all the comments and the questions, and thank you.
Yeah, thank you so much, everyone. I think with that, we'll bring the seminar to an end. Yeah.
Thank you very much.
Thanks.
Thank you.
Thank you.